Stock market crashes are the biggest worry of every investor, and every investor wants to know when the next stock market crash will occur and how long will it take for the market to recover. As Mark Twain said, history never repeats itself, but it does often rhymes. So in today's video, we'll study the history and look at all the times when the stock market crashed in the past 70 years from 1950 to 2020. We will also look at how much time it took for the market to recover after these drops. The purpose of this video is to help you understand the frequency and size of historical market drops, which will help you improve your understanding of the market crashes. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running, and if you find this video helpful, then show your support by liking and subscribing to the channel. Alright, we will begin by grouping the market drops into three categories. The first represents the big drop, which we will call a market crash. Market crash represents more than 20% fall in the market. Next category is the medium drops, which we will call market correction. Market correction happens when there is a drop between 10 to 20%. Lastly, we have got the small drops, which we will call market dip. And we will define market dip as something between 5 to 10%. Now that we have categorized the market drops, let us look at how often these drops happen, how bad they get, and most importantly, how long does it take for the market to recover. Let's dive into understanding market crashes, the kind of events that can seriously impact your investment portfolio. Over the past 70 years from 1950 to 2020, there were 12 instances where the market crashed more than 20%. So on an average, the market crashed every 5.8 years. But averages don't tell the complete story, because the time gap between two crashes can vary a lot. Sometimes it can be as short as 2 years, like between 2000 and 2002. Other times it can stretch out to a whopping 13 years, like between 1987 and 2000. So when the next crash will happen from the previous one is very unpredictable. But when crashes do happen, the market can drop anywhere between 20% and 50%, with the average decline sitting at about 33%. Now let's talk about the recovery. How long does it take for the market to bounce back? On an average, it takes about 2.5 years for the market to reach back to its previous peak. But recovery times can be as quick as 6 months, as we saw during the 2020 COVID-19 pandemic crash. On the flip side, recovery can also drag out to 5 to 6 years, like what happened after the 2000 dot-com bubble burst. Now let's analyze stock market corrections. That is, when the market sees a decline ranging from 10 to 20%. Since World War II, there have been 24 market corrections across 75 years, from 1945 to 2020. So on average, it seems like the market corrects itself about every 3 years, and the average drop during this correction is around 14%. But here's the thing, averages don't tell the complete story. Especially since the 1980s, we have been seeing more frequent market corrections. But the good news though is that recovering from a correction is pretty fast. Unlike the slow recovery periods after market crashes, market corrections usually bounce back in just 4 months on an average. So if the market experiences a 10 to 20% drop, the good news is it tends to recover quickly, often within few months. Let's dive into market dips. That's when the market falls somewhere between 5 to 10%. These dips happen pretty much every year, and often we see them happening multiple times within the same year. Looking at the chart, we can see that since 1980, we have been experiencing this decline of 5% or more, about 4.6 times each year on an average. So in simple terms, these smaller market dips can happen several times in a year, but the good news is they tend to bounce back pretty fast. It's like a quick hiccup rather than a prolonged setback. Now let's talk about the strategy to deal with each type of market drop and try to sum up what we have learned from this analysis. Market crashes, those big drops of 20% or more, tend to occur roughly every 6 years, with an average fall of about 33%. Recovering from these can take around 2.5 years on an average. Now during a market crash, most people panic and sell their investments, which is one of the biggest mistakes that most investors commit. So if you ever find yourself in middle of a market crash, the smart move is to hang in there for the long term, probably for a few years at least. Then there are market corrections, the 10 to 20% drops, which happens approximately every 3 years. They usually have a milder average decline of about 14%. But the good news is they bounce back pretty quickly, often within few months. So if you find yourself in correction, don't panic, but in fact, it could actually be a good opportunity to invest more money at discounted prices for the long term. Thirdly, market dips in 5 to 10% range can happen several times in a year, and also the market recovers from these dips very swiftly. This small volatility of the market is part of an investor's journey, and having a long-term investing mindset helps an investor to not panic or be bothered by small volatility. While it's impossible to predict exactly when these events will occur, the best strategy, especially for dealing with big crashes, is to stay invested for the long term and not sell in fear or panic.